The Borrow Smart segment today being brought to you by GetHomeselect.com. GetHomeselect.com. Home buyer tax benefits, navigating deductions and credits for 2024. Ron Siegel Radio, your go-to source for all things home ownership, financial planning, and community building. I'm Ron Siegel. Today we're here diving into a topic that's top of mind for many of you, especially with tax season upon us. Tax breaks for buying a home. It's that time of year again when we're all gathering our financial documents, getting our ducks in a row, and thinking about taxes because we wait till the last minute. If you're a homeowner or a first-time home buyer, there are some potential tax breaks you should know about. It's important to understand that I am not a tax professional. The information I'm sharing today is general, so please consult with a qualified tax expert for advice tailored to your specific situation. Now, let's clear up a common misconception. Deductions and credits are not the same. A deduction reduces your taxable income, which in turn lowers the amount of tax you owe. The amount your income is reduced depends on your tax bracket. There are two types of deductions, standard and itemized. Standard deduction is a fixed amount that varies based on your filing status and is updated each year. Itemized deductions are specific expenses you incurred during the tax year. You should itemize if the total of your allowable itemized deductions is greater than the standard deduction. A credit, on the other hand, directly lowers your tax liability by a fixed dollar amount. Keep in mind that some credits are non-refundable, meaning if you don't owe much in taxes, you might not get the full credit. However, refundable credits, like the Earned Income Tax Credit, can result in a refund even if you don't owe taxes. Now, it's also crucial to know that home ownership expenses cannot be deducted. These include things like closing costs. That's title insurance and appraisals, depreciation, payments for domestic service, your down payment, fire insurance, mortgage insurance premiums, the principal portion of your mortgage, and regular utilities like gas, electric, and water. So what can you deduct? Let's get into the details. One of the most important and significant tax breaks for homeowners is the home mortgage interest deduction. This allows you to deduct the interest you pay on your mortgage up to $750,000 or $375,000 if you're married filing separately. If you're taking out a home equity loan or a HELOC for homeowner improvements, you can also deduct that interest through 2025. You'll claim this on Schedule A of Form 1040. Another common deduction is property taxes. Whether you pay them monthly or yearly, state and local property taxes are deductible on your federal return. However, there are limits. For 2023 tax year, the deduction is capped at $10,000 for married couples filing jointly, $5,000 for other filing statuses. You can also deduct property taxes paid at closing, but not those paid on commercial or rental properties. This goes on Schedule A of Form 1040. Another deduction to be aware of is the mortgage points. When you get a mortgage, you can sometimes purchase mortgage points to lower your interest rate. You can deduct these points either in the year you get the mortgage or over the life of the loan. Again, there are limitations, so check the IRS website. This is also claimed on Schedule A. For those of you who are self-employed, there's a home office deduction. If you use a part of your home exclusively for business, you can deduct certain expenses. This means your home office needs to be a dedicated space, not just your bed with a laptop. Occasional freelance work does not qualify. There are some exceptions, such as if you use part of your home for a daycare business or to store inventory. Deductible expenses can include refurbishment and repairs, depreciation, a portion of your rent or mortgage, a portion of your utilities, business insurance, and office supplies. However, you cannot deduct landscaping or lawn care unless that's your business. There's also a simplified method where you can deduct $5 per square foot of your home used for business. Now, here's an important note. If you're a traditional employee, the Tax Cuts and Jobs Act eliminated the ability to deduct unreimbursed home office expenses until at least 2026. To claim the home office deduction, you'll need Form 8829, and it doesn't stop there. If you rent out property, you can deduct some landlord expenses, including operating expenses, depreciation, and repairs. However, these deductions are only for maintaining the property, not for improvements. This is claimed on Form 4562. You might also be able to deduct medical capital expenses. If you need to make home improvements for medical reasons, like installing ramps, widening doorways, or modifying bathrooms for accessibility, Some or all of those costs may be deductible. Beyond deductions, there are also homeownership tax credits. Some first-time lower-income homeowners might qualify for a mortgage credit certificate, which can subsidize up to $2,000 of interest. If you're investing in clean energy, there's a residential clean energy credit. Similarly, the energy efficient home improvement credit is available if you make energy efficient upgrades to your home. And finally, if you own an electric vehicle and installed a charging station in 2023, you might qualify for the alternative fuel vehicle property credit. A lot of stuff in there. And again, remember, we want you to chat with your professional, so that your tax professional, so they can help you. Remember, it's all the time I have for today, but remember, I'm Ron Siegel, Certified Liability Advisor, CLA, helping families build wealth through strategic debt management. If you have questions about today's topic or need guidance on managing your debt, give us a call at 800-306-1990, 800-306-1990.